Good evening, everyone. Good morning to Lauren. And once again, a very warm welcome. For a cricket
Thank you.
crazy nation, that is India, scoring half a century is an important milestone. And all of you would agree with me. Guess what? Millennium Mams just scored 51 with online events. Is the 51st event today. And it was motivated by our yearning for continuous learning, which is one of the important pillars of Millennium Mams. We are grateful to our founder mentors, Mr. Vishnu Dhanuka and Mr. Sanjay Bhuvania, who founded this unique organization 28 years ago, without whom we students and investors wouldn't be here. Thank you, sirs. And apart from the speaker sessions, our mentors are helping us take our learning of the long-term value investing to the next level through regular classes on practically all days of the week. Our zeal to upgrade our knowledge of long-term investing took us to Omaha twice and attend the Berkshire Hathaway AGM and get the feel of how the meeting is conducted by the legendary investor, Mr. Warren Buffett. I would like to start today's session with a quote by Sir John Templeton. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. Why am I starting with this quote? No prizes for guessing. Our guest of honor, Lauren Templeton, founder and president of Templeton and Phillips Capital Management, LLC, and great niece of Sir John Templeton. Lauren, it's an honor to have you with us today. Lauren is part of the Templeton legacy, having been groomed in the art of value investing by her father and her late grand uncle, Sir John Templeton, no less as a child. Now, that's what I suppose starting early in investing really means. She began her career as a junior associate at the financial advisor Homrich and Burke, and later the hedge fund management company New Province Advisors, both of Atlanta. In 2001, Lauren launched her own company, which dedicates its efforts to the practice of value investing across the global markets using the same methods learned from her great uncle, Sir John Templeton. She serves on the board of directors at Fairfax India Holdings Corporation, among others. She's a current member of the John Templeton Foundation, Templeton World Charities Foundation, and a trustee of Templeton Religion Trust. She's also the co-author of Investing the Templeton Way, the market-beating strategies of value investing's legendary bargain hunter. Do the tenets of value investing hold good in these unprecedented economic conditions? If so, how does one find a company with a bright prospect now? Does the Templeton way of screening companies remain unchanged? The bad news is we are in a pandemic. What's the good news and what stocks to buy? This is taken from Sir John Templeton's statement about the 1987 Wall Street crash. And that meant the bad news is we are in a bear market. The good news is it's almost over. So let's find stocks to buy. Without further ado, I would like to invite Lauren to address the member of Millennium Mams, and then straight away we can dive into Q&A, moderated by my colleague, as I said, the boss lady, Nameeta. So let's start with trouble is opportunity. Lauren, over to you.
Thank you so much for having me here today to discuss investing in a crisis. We are certainly in a global crisis right now. You know, and I am in a unique position in that I get to view this crisis from a variety of perspectives. So I do run an investment firm located in Tennessee focused on global value investing. I launched the firm in 2001 with $30 million in seed capital from Sir John Templeton himself. My husband and I run the business together, and we spend all of our time studying Uncle John's investment philosophies and reviewing his thinking on almost every investment he made. I'm also on the board of 3 publicly traded companies, so Fairfax Financial, Fairfax India, and Canadian Solar, which manufactures solar PV modules and develops and manages large-scale solar projects. We have major manufacturing in China, so that is a unique vantage point that I have. And I run a startup business as well, focused on used children's clothing. And that's exciting. And that's a
news.
female. It is. That's a fun little side project I started a few years ago. We employ only women, and it's a very empowering startup business called shopbagsy.com. So I get to see the pandemic through that viewpoint, because our revenue is down 25% year over year. That's been interesting to see. And I'm also on the boards of several nonprofits. So I'm watching what their endowments do. I'm on the investment committee for the John Templeton Foundation. And importantly, I'm on the board of trustees and the endowment committees of both of my children's private schools. So I'm getting to see how their investment portfolios have reacted. And, in the United States, schools and 501c3 organizations, which are charitable organizations, basically, they're drawing about 5% a year from their endowments. And then if you put an inflation expectation on top of that, really the bogey for these organizations is about 8% a year in investment returns that they need to just preserve their corpus going forward. So it's certainly a unique time to think about investing and how to maximize your returns going forward. So I love that you started with one of Uncle John's quotes. It's one of my favorite quotes. As you may not know, but he was really the pioneer of international investing. He's one of the first investors to do that. I grew up watching Wall Street Week with Louis Rukeyser and was sort of fed a steady diet of BLTs, which in my family is called Buffett, Lynch, and Templetons. And I also like to start my presentations with a few of his quotes. So I'm going to do that now because it really sets the tone for what we'll discuss later on in the presentation. The first is, a major cause of higher prices is higher prices. But when the trend is reversed, lower prices lead to still lower prices. To buy when others are despondently selling and to sell when others are avidly buying requires the greatest fortitude and pays the greatest ultimate rewards. And the second is the quote you gave, but I like the first part of it, which you didn't mention, which is, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. An investor who has all the answers doesn't even understand the questions. And then lastly, if you want to have better performance than the crowd, you must do things differently than the crowd. And that's really our perspective at Templeton and Phillips Capital Management. We believe that there are 3 sources of alpha when it comes to investing. You can have better information, you can have a better model, or you can add alpha by having better behavior, which is the approach that we use. So we're very contrarian here at Templeton Phillips Capital Management. We're always looking for a crisis to deploy capital. It's a very important part of our strategy. So we look forward to these events. So let me talk to you a little bit to set sort of the tone of the economic environment that we're in right now. So most people associate recessions, or investors associate bear markets with economic pain and hardship, unemployment, perhaps increased anxiety. And while that's the case for many, studies indicate that there are always a few firms that play a smarter hand to emerge from a downturn stronger. And today we'll discuss how companies do that and give you some data. The Harvard Business Review concluded that during the recessions of 1980, 1990, and 2000, an average of 17% of firms disappeared. 9% outperformed their competitors by 10% or more in sales and profits. So, 9% of firms actually strengthened and outperformed. There was a Bain study that was conducted on the 2008-2009 recession that said 10% of firms increased EPS through the recession and afterwards. And then lastly, The Economist has a study that says in the previous 3 recessions, top quartile returns were 6%, a positive 6%, and the bottom quartile were negative 44%. So let's talk about how to pick an investment and focus on these top quartile businesses that can strengthen themselves through the pandemic. So one thing that we should discuss is the current credit environment. So currently right now in the US, bankruptcies really increased in the early days of the pandemic. And while I know this current environment has been shocking to some and caught many of you off guard, we believe it has been 10 years in the making. So following the great financial crisis of 08 and 09, zero-bound interest rates were kind of certain to produce some financial mischief, if you may. And we noticed around 2014 that debt excesses were appearing in the corporate sector, most visibly in the explosive issuance of covenant-light debt and second lien debt. So yield-starved investors seeking yield were happy to lend without demanding sufficient protections in the debt markets. So in the 6 years leading up to COVID-19 panic, many companies borrowed money or issued debt to repurchase shares. They issued dividends, and in some cases, they made expensive acquisitions. So corporate debt was at an all-time high going into the pandemic, but corporations had not used this debt to invest in growth. They were really pursuing different strategies, issuing dividends, buying back shares, and making expensive acquisitions. So we really puzzled over this phenomena here at our company, and we didn't know what would make it stop. So unfortunately, it required a global pandemic to stop it. But when the COVID-19 panic hit, many businesses found themselves with reduced or even zero revenue due to shelter-in-place orders here in the United States. And you can see, we really had this sharp uptick in bankruptcy filings. But the only surprising thing, frankly, was that there haven't been more. So as you know, in the United States, our government stepped in with aggressive aid and stimulus, both fiscal and monetary. So the looming question really remains to me is, have we simply hit the pause button? So most people in the investment industry, including myself, we believe that there will be a likely rise in bankruptcy filings over the coming years. So who were the firms that filed in early March and April? These were firms that were already in trouble. So they were dying a slow death due to their inability to adapt to change, mostly technological, and in many cases did a poor job of managing their balance sheets. But going into the pandemic, corporate debt represented record highs, and in many cases, companies had not used that capital growth for growth. So for instance, according to Barron's, over the last 10 years, 20% of the Russell 1000 paid a dividend in excess of free cash flow. 30% of companies made a buyback that exceeded free cash flow. So that just shows you that many companies went into this pandemic, they were not healthy. And why haven't we seen more bankruptcies? Well, we haven't seen more bankruptcies because, you know, governments have stepped in providing stimulus, both monetary and fiscal. And we think the bankruptcy filings will continue to increase in the years coming out of the pandemic. But who were some of the early filers that you may recognize? These are companies like Hertz, JCPenney, Neiman Marcus, Brooks Brothers, GNC, J. Crew, and Chuck E. Cheese. These are companies that weren't well positioned going into the pandemic. So what's really remarkable, though, is that one would assume in this environment that corporate credit would tighten, that it would be harder to issue debt, right? Companies aren't necessarily as healthy as they have been in the past. You really expect credit to tighten in an event like this. But we have seen the exact opposite. So there has been really record debt issuance as the Federal Reserve has stepped in to support credit markets. And as you know, the Fed is the lender of last resort and is very active in the market buying up issuance of new debt. And the Fed has purchased approximately $2 trillion worth of debt. So, you know, we're seeing the exact opposite of what you would normally expect in a crisis event where credit would normally tighten. Instead, you've seen this explosive issuance of new debt. So companies, if they can, are issuing debt and they have access to cheap capital. Why does this matter to you? Because we think this is really creating a very unique situation where you're going to have this legacy of sort of zombie companies walking around, a la Japan, what we've seen in Japan over the past few decades. So just to go back and give you some color on this new issuance, this recent issuance of corporate debt. So new issuance has been both in the investment grade credits in the high yield market. And something worth pointing out to your listeners is that 50% of investment grade credit is in the BBB tranche. So when you're looking at debt, that's the lowest tranche before you hit junk status. So this is unique. We've never seen this before. And what it means is that there's a lot of questionable investment grade debt out there. So there's a lot of debt that is considered, quote, investment grade because it's BBB in status, but it probably shouldn't be. So I think that's really something for you to keep in mind. So also debt issuance in general is twice the normal rate, even though firms have reduced cash flows. I mean, that makes no sense, right? Revenues are down, cash flows are down. You would expect corporate credit to tighten, but it hasn't. It's gotten looser, and debt issuance is twice the normal rate. So this just can create lots of problems. We think we're kind of kicking the can down the road, so to say. So currently we see a rising share of shares of companies with debt servicing costs that are higher than profits. So that number is increasing. More and more companies have higher debt servicing costs than profits. This is not healthy. So this is what I mean when I made the reference earlier to a zombie company. That's what I refer to as a zombie company, sort of the walking dead. When you're in that position, all you can do is service your debt. You cannot invest in the growth of your business. You can't fund the growth. So this is a really dangerous situation for companies to be in. Can you still hear me and see me?
Yeah, Laura.
I think I've lost.
Yes.
No, okay. No. I thought I'd lost you guys for a second.
It's absolutely fine.
So, okay, good. With all, what we call zombie companies that are going to be walking around, you can really anticipate that growth is going to slow. So GDP forecasts, as you've seen them, have naturally been revised down, and it's going to take longer to get back to where we were because zombie firms can't grow. They can't invest in growth. They can't invest in research and development or expansion. So this really is analogous to what we've seen in Japan over the past 20 to 30 years, high debt and low growth. And so this is creating, just a really unique investment environment. We are certainly making investments. We were buying heavily in March and early April, and we actually reduced the number of positions in our portfolio. We became more concentrated, but we really focused on making investments into two different areas that we see are really long-term secular trends. And so those are the digitization of the economy, so mostly e-commerce businesses, as well as ESG. So let's start with digitization. So we think those are the two long-term secular trends, ESG and digitization. So when you start with digitization, the US e-commerce penetration is actually pretty low. So looking back at the great financial crisis of 08 and 09, it was a lot of people missed that there was this huge explosion in the digital economy that came out of the crisis. So everybody at the time during the great financial crisis, most people were hyper-focused on the financial system, failing banks, struggling capital markets, and fiscal and monetary stimulus. But really, e-commerce penetration quadrupled in the years that followed the great financial crisis. And we believe that a similar trend is underway. So that's just something for investors to consider when you're looking at stocks. Are you investing in a company that is healthy, okay, that doesn't have a huge amount of debt? Can they reinvest in growth? And are they making sure that they're keeping pace with the digital economy? Are they making the investments they need to grow in this space? So even though that we're 20 years past the dot-com bubble of the late 1990s, there's still plenty of room for growth and adoption of new technologies. E-commerce penetration rates, really the largest economies like China and UK are way ahead of the US. And one thing I will note is that I was blown away when I visited India about how, really easily you guys had adopted technology. Like I felt like the US was way behind India in so many ways, whether that was mobile banking or, checking into the airport and, using the iris scans and all of that stuff. I came home and I thought, wow. But that's because, India isn't burdened by these legacy systems that we have in the United States, where we're trying to piggyback off of a legacy system. You guys can just adopt the new technology and go for it. And it is a huge advantage for India and Indian businesses. So that was really, really impressive for me to see when I was there, and shocking. I just did not anticipate that at all. So when you think about the role of digitization in business at the business level, one obvious thing that comes to mind for me is remote work. So I know, India has a lot of remote workers, and India is working from home right now. I think you could tell me better, but it seems like a lot of people are still working from home. When I'm dealing with large accounting firms, custodians here in the United States, the largest businesses, State Street, PwC, all of these companies have outsourced everything to India. So that was really interesting to see during the pandemic, right? Because how well is that going to work? And in many cases, these were new outsourcing relationships. So I think I could be completely wrong, and PwC could correct me on this, but I mean, I really think they did a lot of their outsourcing to India in the year to 2 years leading up to the great pandemic. So you're really testing what that looks like. But the reason I bring that up is, you know, every CEO, based on the data I'm seeing right now, thinks that some percentage of their workforce is going to stay remote in the future. So this is an opportunity for businesses to transition some work from home employees to independent contractors, possibly. And also I read a really interesting statistic that says in New York, the average company spends $17,000 US per employee for office space. So, you know, I think we're going to see some really profound effects coming out of this, affecting commercial real estate and other lines of businesses. So to drive home the point of digitization, increasingly customers are really expecting more, and they want access, and you know, they want order tracking, they want order placement, they want to be able to reach people in off hours. So when you're considering investments, do consider this trend towards digitization, because we think it's going to increasingly grow coming out of this crisis. Let's see, what else do I have to share with you today? Yeah, so, you know, while digitization is an important trend, it represents both trouble and opportunity, I would say. So the opportunity for those who use it in their business is to increase their efficiency and lower their break-even costs. But it's really potential trouble for those businesses that are ignoring it. So again, when you're evaluating your business, when you're evaluating potential investments, you really need to look to say, is the company reinvesting in digitization, trends, AI, anything like that, that can lower their break-even cost? If they're not, you might be staring at a value trap. So a company that is not going to grow coming out of this recession. And then the next big trend we're seeing right now is this move towards ESG, which is a renewed focus on environmental, social, and governance policies. So one thing I'll say is that I think, you know, particularly in the United States, that's been driven by the current administration. So the current administration really came in the US and reduced a lot of regulation for businesses, you know, 4 years ago. And that was a great thing, because businesses thrive in an environment where there is reduced regulation and bureaucracy. But because I think savvy investors saw, okay, these policies, environmental, social, and governance policies, aren't going to be regulated by the government, we're going to have to look to companies to do it themselves. So I think that you're going to see that as a big trend that continues in the investment industry, and you'll see investors demanding greater environmental, social, and governance policies. I mean, of interest to your listeners, I would say that, you know, it's a great time to be a woman because everybody wants a woman on their board these days. You know, it's, it really, that's, you know, I'm on 3 corporate boards of publicly traded companies right now. So there is this, I think, appreciation of diversity of thought. And, you know, we all know that we make prudent investment decisions and that we're very responsible, particularly when it comes to money. But I think you're going to see that more and more. And so opportunities will certainly increase for women in finance and to take leadership roles in this industry. But I do think that you will see this push really affecting businesses and their decisions coming out of the crisis. I think it will get even more exaggerated. So, you know, what are some things you need to look for in a company? at our company, we have a very disciplined investment process. And I learned that from my great uncle, Sir John. You know, a lot of people think of him as this great macro investor, but he wasn't. He was very bottoms up. He relied on valuations to tell him where he should invest in the world. He was doing it in a different era. I mean, he was using value line to rank stocks by hand. And now we can all hop on Bloomberg and download everything into Excel spreadsheet and, you know, rank stocks that way. Are you guys still there? You just went black on me.
Yeah, Laura?
Okay, you can hear me?
Yes, absolutely.
Sorry. But so what we do is we take a universe as large as we can get it, any company we can get data on, and we run really basic valuation screens to drill down into the bottom decile of the market. And what you'll find is that the same companies kind of hang around that space. They're kind of always in the bottom decile. And those are the value traps. You know, you run these screens every day, every week for 20 years. You know which ones are there. And so when you see something new sort of hit the bottom decile of the market, you have to ask the question, why is this company there? Is this company well capitalized? Is it discounted for a temporary reason? And if the answer is yes, then we engage in qualitative analysis and further quantitative analysis, in that we do a discounted cash flow model. Usually it's what we're using. We run that model over various scenarios, and we're looking to buy a stock that's trading at 50% discount to what our approximation of fair value is. So that's a pretty wide margin. A lot of value investors are really looking for 20 to 30%. We're looking for a 50% discount because, like most women, I probably am less confident than other people. So I like to have this really big margin of safety when we're analyzing stocks. So that's how we do it. But you know, what are some things that you could be looking for now in a company? Well, first, I think a company that's going to emerge out of this crisis is a company that is well capitalized and is investing in their brand and customers throughout this crisis. So customers are really facing uncertainty right now, and you want to look at companies that are being really creative and investing in their brand and customers now. So a good example of that was Hyundai. So in the 2008 downturn, they introduced something called the 100,000-mile warranty, and their year-over-year sales increased by 24%. So that's something you want to look at. Is the company just servicing debt right now, or are they investing in their brand and customer? Also, you know, it's a good time for companies to try new revenue models. For instance, you know, I think some companies are being really creative right now with subscriptions and gift cards that can enhance working capital if executed correctly. So receiving revenue in advance of a goods or services provided is really an interesting strategy that you see a lot of companies pursuing right now. For instance, Starbucks generates an interest-free $1 billion loan to working capital through its gift card program. So that's just something I would be looking at. Are companies being creative and trying new revenue models at this time? And, you know, is the company operating in a decentralized manner? I think that's an important thing to consider when you're analyzing companies. Are they using COVID as an opportunity to sort of get rid of past baggage and reduce wasteful expenditures that perhaps might have been politically challenging to do pre-COVID? Cost cuts, really, when you're looking at a company right now, cost cuts should be focused on improving operating efficiency and not just reducing headcount. So when you look at a company and you you're studying them during this pandemic and how they're reacting, and they're cutting costs, what type of cost are they cutting? You don't want to look at somebody who's just reducing headcount. So you need to look at a company that is making changes to improve their operating efficiency. So that's something that I would have my eye on. And then, you know, a company that is investing their savings towards the recovery. So technological advances will continue, and the opportunity cost for investment in technology now is lower because we're in a recession. So if you invest in technology now, your resources are not being diverted away from capturing robust sales in a stronger environment. So your opportunity cost of technological upgrades, investing in technology now, is lower than it's ever been before. So you want to see a company that is long-term focused, that is investing for growth now, not just reducing headcount. And if they are reducing cost, are they improving their operating efficiency? So those are all the things that we focus on today. And then, you know, I would just remind your viewers that in times of crisis and this current pandemic, it's very difficult to make yourself go in and purchase stocks in a scary environment. Human beings aren't really hardwired to be good investors. So it's something you have to cultivate through a very disciplined investment strategy. And it's something that you all can learn to do, to be contrarian in your thought process. Uncle John, you know, as you know, he lived in the Bahamas and he managed money there. And I asked him one time what it was like managing money in the Bahamas, and he said that his returns improved when he moved there. And I thought, well, that's odd. Why do you think your returns improved? And he said, well, I think it's because I read the Wall Street Journal a few days after everybody else. So I think that is something to consider. Removing yourself from the herd, not reacting to things in the market, having a long-term focus when you're analyzing a company, making sure they share the same values, meaning they also have a long-term focus. Those are all the things I would look for now. So, you know, I still think it's an interesting time to invest. I mean, obviously the markets aren't cheap like they were in March and April, and it's certainly harder to find a bargain opportunity, particularly in the US. But there are opportunities available globally, and you just need to be careful to invest in companies that have the ability to invest for growth in the future and not just service debt. So you're going to have to watch out for these zombie companies and know that the zombie companies are going to bring down growth rates around the world. So you're going to see GDP forecasts continue to fall, because when companies are just servicing debt, they're not investing in the growth of their business. You know, you're going to see GDP continue to decline. So that's sort of our view on the current market and how we're looking for opportunities. We have not made a new investment since April. In April, we really restructured our portfolio. We got rid of some stocks that I actually still really like, but I felt like that we had larger opportunities in other names, and our portfolio is heavily tilted towards e-commerce and the digitization trend that we think will continue to emerge out of this pandemic. And that's it.
Yeah. Thank you, Lauren. Thank you so much for this insightful presentation. Nameeta, are you there?
Yes,
Yeah.
Rachna.
Over to you, Nameeta.
Lauren, I read somewhere that you started investing at the age of 7. So you seem to have beaten Warren Buffett at his game as well, isn't it? What I also wanted to actually go further ahead. So you must have seen lots of bear markets, and obviously you're like a veteran at it, and you would be in the best position to tell us about this. You said that your behavior in bear markets will determine your lifetime results, and I quote from what you have said. Would you like to elaborate on this behavior?
Yeah, a bull market lifts all boats. So really your returns are going to be determined by your actions in a bear market. So whether or not you can buy when others are despondently selling and sell when others are avidly buying, as Sir John would say, that really is, to me, your opportunity to differentiate your returns from the herd. I mean, in a bull market, everybody sort of participates. It's really hard to stand out. But I think that your return pattern is certainly determined by your behavior in a bear market and how you react to it. Do you sell stocks? Do you buy more? Do you transition from positions that you think have 100% upside to positions that have 200% upside? How do you control yourself in a bear market and harness the power of a bear market? We always think of a bear as being up on his hind paws with both of his hands in the air. We think of him slapping us a high five, right? Like Sir John said in the 1987 crash, he said, these stocks are going to make our returns for years to come. So, we depend on these events to outperform our competitors and distinguish our returns, because most people, frankly, they're not buying at the bottom of the market. They're too scared to do it. And this goes back to my comment earlier of 3 sources of alpha. There are really only 3 sources of outperformance in the market. So you can have better information, but that's pretty tightly regulated these days with Reg FD, and certainly an area where we don't play. And you can build a bigger model and a better model. So, those are all the algos in the market, and or you can distinguish yourself by having better behavior. And that is by buying, at the bottom of the market. So that's what I mean by that.
You talk about certain behavior biases as well. If you can elaborate on that, that would be helpful.
Yeah. So that takes me to another presentation that I usually give, but behavioral finance is really just a fascinating topic to me. And I got interested in this probably 15 years ago. And every book I picked up on the subject mentioned Sir John Templeton. And I thought, this is so interesting. Why did they all mention his name? They were all quoting him extensively. And it really is because I think he was sort of the first behavioral finance expert. But not to go down this rabbit hole, because we could be on here all day and talk about this. But your brain, let me give you a good book to read on this. And this person describes it much better than I do. But James Montier has some really good books on this. And I think he has one called The Little Book on Behavioral Investing. And then he just has a bigger book called Behavioral Investing, I think is what it's called. But he does a great job of explaining it. And the way to think about the human brain is there are 2 processes that run simultaneously in your brain. And your brain takes in a huge amount of information all at once. So they say 40,000 bits of information per second, even though you may only be consciously aware of about 40 bits of information per second. Your brain is taking in and processing 40,000 bits of information per second. And you have 2 parts of your brain. One is called your amygdala, and the other is the prefrontal cortex. So when information comes into your brain, Your prefrontal cortex processes this information. Your prefrontal cortex is a very analytic system. It is very logical. It's very step-based. So to give you a good example of that, let's say you're walking down the street and you see a dog and it's coming towards you and your heart starts beating really fast and you start sweating. That's your amygdala. But your prefrontal cortex sees the same scenario, looks over, notices the dog is on a chain, the dog's behind a fence. It's just very logical, but it's slower. It's a slow deductive system. To bypass this and keep you alive as a human being, your brain relies on really this amygdala. And to process those 40,000 bits of information very quickly to keep you alive in the world, it relies on some mental shortcuts that scientists call heuristics or biases. So these heuristics and biases that we have as human beings are very important in keeping us alive, but they're not helpful when it comes to investments. So these are things like hindsight bias, confirmation bias, the mental accounting that we all use. And these are pitfalls for investors. And they have proven that if you're just aware of these biases that you have as investors, that your investment returns improve. And I have to say, I think that's true. It's fascinating to get a book on all these mental biases that we have and how they're expressed when you're making financial decisions. And you'll catch yourself making these mistakes because it's very natural. And you'll start to identify this in your behavior. And when you do, you can think of ways to bypass these mistakes.
Right.
Like at our firm, we have sort of an unwritten rule that we make investment decisions first thing in the morning, that we don't make any decisions in the afternoon. And a large part of that is because your self-control really diminishes throughout the day. You have a limited amount of self-control and it's higher in the morning. So it's a very good time to make important decisions in the morning and not do that in the late afternoon. We have policies in place at this firm to prevent confirmation bias, where we try to read opposing views instead of just reading reports that echo back what we think on a stock, an industry, or a country. We try to read things where people think the opposite of us. So, I mean, I could speak all day about this subject, and it is just so fascinating. I would encourage you all to pick up a book on behavioral finance and read about these biases. My favorite one, and I'll just tell you real quick, this isn't, it does impact investing, but you see a lot of these biases in Las Vegas with gamblers. So let's say a gambler comes into a casino and they brought, let's say, $100 with them, and they gamble the money and they win $50. Okay, human beings have a tendency to segregate money. Okay, so they've even got videotapes of people doing this. So they'll put the $100 that they came with in one pocket, and then the money they won in another pocket, and they do completely different things with that money. So the $100 that they came with, they save it to pay their rent or whatever. The $50 that they won, they'll go do things that they normally would never do in real life. Like they would buy a very expensive meal or expensive handbag, things that they would never do in real life with their own money. Well, money's the same, right? So it's just interesting. And the way that plays out in the market is in a bull market, when you have investors invest and their stocks go up and you see that risky behavior starting to build. People are already making decisions with the money they've earned in the market that would be different than they normally make. And the risk taking continues to build and build and build until the market pops, the bubble pops. So that's kind of how that manifests itself in investing. But it is a fascinating subject. And there are people that speak much better on it than I do. But I think you would enjoy reading about it.
Thank you. Thank you, Lauren, on that one. Rachna, you had a question?
You can call in other people now. I've already asked my question. Let others have a chance.
Meghna?
Yes, thank you, Nameeta. Lauren, I can't have enough of hearing about Sir Templeton. So could you please share your personal greatest learning from him?
Oh, gosh, I've learned so much from him, and I continue to learn a lot because he also wrote so much. And so I have all of his writing, and I can go back and review it, and I continue to learn new stuff every day. I would say the biggest lesson I took from him is not to focus too much on your mistakes when it comes to investing. So I saw him make mistakes when it came to investing, and he was always very quick to acknowledge them and move on from that. So I think particularly women sometimes want to be perfectionist, and they want to have everything planned out and have read everything and studied everything before they make their first investment. They fear making a mistake.
Yes.
And I think you can learn so much from your mistakes. And he always told me, and he was known as the world's greatest stock picker. He spent a lot of time thinking about it, and he said, I think I'm right 60% of the time. That means he was wrong 40% of the time. 40% of his decisions were not correct or didn't have a good outcome. So I think the average investor can expect that they're more than 40% of their decisions will have a bad outcome. And that's something you just need to learn from and embrace. And I think women sometimes can get stuck where there's no action. They don't ever invest for the first time because they're so afraid of making a mistake. But really, compounding is a magical thing, and the magic ingredient is time. So the earlier you start, the better. And time can hide a lot of mistakes once you get that compounding machine going.
Thank you. That was very inspiring. Thanks, Lauren.
Mm-hmm.
Lauren, we at Millennium Mams also love that compounding machine.
Yeah.
That's the edict that we live by. Rachna Bhagat, she has a question for you, Lauren.
Okay.
Hi, Lauren.
Hi, Rachna.
I'm completely fascinated by your insights on behavioral investing. And I saw myself in so many of those insights. So could you suggest a good book on it?
Yes. So I love James Montier's book, The Little Book on Behavioral Investing. It's called The Little Book on Behavioral Investing. And then he has another book called Behavioral Investing. But obviously, Daniel Kahneman has the best known book in that, and he won the Nobel Prize for his work there. And his book is called Thinking Fast and Thinking Slow, I believe, if I remember it correctly. But those are all good books. And then I also enjoyed another book called The Hour Between Dog and Wolf. That's another good book on the subject too. But there are lots of them out there. If you just Google behavioral investing, you'll come up with a lot of recommendations. And I do recommend you learning about all of these biases, because when you start reading about them, you're like, oh, I do that. I see where that is an issue for me. And then it's pretty easy to adjust your behavior to avoid the behavioral biases. One thing that we do at our company that I would recommend to all of you, which I think is very powerful, is that we keep a list of sort of our dream stocks in our desk drawer. So these are companies that we really like. We admire the way they do business. They're usually quality firms, and they're usually priced at a multiple that we would never buy. They're just too expensive for us, and we believe in adhering very strictly to our discipline. And so what we do is we keep this list of securities in a desk drawer, and when the market starts to sell off and even seasoned investors get really scared, we then pull out the list and we go to work on the list. And shifting your mindset to focusing on the opportunity instead of focusing on the loss or, you know, the crisis in the market is really powerful. It is this just energy shift in the office when we pull out that list, because, you know, even really seasoned investors can get very nervous in a sell-off. In the early days of the pandemic, you know, I really couldn't believe what I was hearing out of really seasoned Wall Street veterans. And you hear that in the great financial crisis, they were like that too. But when you pull out a list of companies that you want to buy, that you've studied beforehand, and you shift your energy to focusing on what opportunity you have, it is powerful, and I think negates a lot of these biases that otherwise would hold you back. Because what you find is that in a scary event, the human brain, one of our biases is that we do something called social proofing. So when we're not sure or we haven't done our own research, you start to look to others to see what to do. And that's what creates this market panic and market sell-off, because everybody's looking around and they think, oh, I want to live to see tomorrow. And they sell their stocks too. That's what creates that behavior. So a good example of that, and I guess maybe it doesn't happen anymore with cell phones and, you know, all the traffic apps. But I always say, you know, when I was a child, you would be driving down the interstate and you get stuck in a traffic jam, and cars would be stacked on the interstate, and you would see one car get off at an exit, and then another car get off, and then another, and then another. And you're sitting there thinking, oh, I bet they know a way around. I bet they know a shortcut that I don't know. And that's really analogous to the social proofing that you'll see in the markets during a scary event. So there are lots of little tools you can use to prevent yourself from selling at the bottom of the market, and to make sure you're doing the most profitable thing, which is buying at the bottom of the market. There are lots of things you can set, rules you can make for yourself.
Yeah, that list would really help. As our mentor says, when preparedness meets opportunity, miracles happen.
Yeah. Yeah. Exactly.
Thank you so much.
Lauren,
You're welcome.
I'd love to take a peek at that list that you have in your drawer.
Yeah, well, I mean, we did purchase Amazon in April, early March, late March, early April. Amazon was a stock that, as a value investor, I thought we would never own. But in late March, early April, it hit its lows that it had not hit from a multiple standpoint since the great financial crisis, 08, 09. So we were able to acquire that at a very reasonable valuation. And that's a good example of a stock that I've always been interested in owning. It met all of our criteria. It was definitely focused on the digitization of the world, and I don't think we would have ever had the opportunity to own it if it wasn't for this pandemic. So that's a good example of a company that was on our list, and we thought, well, now we can buy it. PayPal was another example of a company that we've always thought, yeah, I'd like to own that, but there's no way I'll buy it right now. But it was on our list, and so we pulled that out and went to work. The problem was just getting the trade settled, right? So you had this big disruptive event where all the back office for Wall Street, everybody was working from home. So it became an issue getting trade settled during the pandemic. But we made some very wise purchases that have paid off for our customers and for us. So the list is powerful because most people haven't done their homework in advance. So they're sitting there paralyzed thinking, I don't know what to do. Everybody else is selling. I'm going to sell too. If you've done your homework in advance, you can pull out these amazing companies you've always wanted to own, and that's your opportunity. And it just shifts the energy. You become more positive and optimistic instead of pessimistic. So it's important.
That's the preparedness our mentor teaches, and we've seen it in action with you, Lauren. So you've obviously picked up good stuff. So
I've tried.
We're almost out of time, and I'd like to thank you for these fascinating insights that you've brought in, and in general. And I think there are fantastic takeaways for us. And I'd like to hand over to Rachna.
So before we sign off, Lauren, I would like to ask you one last question. How do you maintain your equanimity in these challenging times? How is it possible for you?
To do what? To maintain my
equanimity.
Okay. You know, how is it possible for me? I think maybe it's just in my personality. I've cultivated it over the years and been in the market a long time.
Wow.
So I've made a lot of mistakes, and
So do you believe in spirituality?
You know, I do.
Yeah.
I think that I spend a lot of time outside.
Mm-hmm.
I spend a lot of time in nature. I do that with my children a lot. I was just corresponding a few months ago with the 2019 winner of the Templeton Prize, Mario Gleiser from Dartmouth University, and he finds spirituality and trail running. And I was telling him that I'm of the same mindset. I love to be outside, and that's how I find, you know, connect spiritually, is to just be outside in nature. And you know, I make a habit to do that a lot. So I'm often hiking, camping, trail running, you name it, with my kids, alone, with my husband. Mm-hmm. And I think that a lot of really well-known investors take the opportunity to go outside. They've all got some outlet where they can go outside and decompress and not be so stressed out by the markets. So yeah, I would say I spend a lot of time in nature, and that's very critical to me.
That's so nice. And Lauren, I would say there are certain moments we always remember in life. And I would say this is one of them. Our mentor started this non-profit organization to empower women through financial literacy. And I'm sure that this session will help us all make rational decisions in these challenging times. And also thank you for sharing your invaluable legacy with us. And we all wish you all the very best for your future. Thank you so much for being here.
Thank you. Thank you for the opportunity. Bye.
Thank you. Bye-bye. Bye, Lauren.
See ya.